At 11:37 last night, a group email marked confidential urgent action required landed in the inboxes of 32 chief risk officers at America's largest financial institutions. The subject line read, Emergency Capital Assessment Protocol Activated. By 2:15 this morning, risk management teams at J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, and 28 other major banks were running stress scenarios they had not been required to run since March of 2023, when Silicon Valley Bank collapsed in 48 hours. This was not a scheduled test. This was not part of the normal annual comprehensive capital analysis and review that happens every June. This was an emergency directive from the Federal Reserve, and it happened over the weekend specifically, so the results could be analyzed before markets open Monday morning at 9:30 Eastern Time. The question you should be asking yourself right now is why? Why would banking regulators demand emergency stress testing of 32 institutions representing $14 trillion in assets with less than 12 hours notice on a Saturday night? What did they see in the data? What are they afraid of? And most importantly, what does this mean for the money sitting in your bank account right now? Let me give you some context that will make the significance of this clear. The Federal Reserve conducts mandatory stress tests every year. They have been doing this since the Dodd-Frank Act was passed in 2010 after the financial crisis. These tests are carefully planned months in advance. Banks know exactly when they are coming. They prepare their data. They run their own internal assessments. They submit detailed reports. The Fed analyzes everything, runs scenarios, and publishes results in late June or early July. It is a highly choreographed annual ritual. What happened last night was not that. What happened last night was the Fed invoking its emergency authority under Section 165 of Dodd-Frank, which allows the Board of Governors to require immediate stress testing if they identify material changes to a bank's risk profile or to systemic conditions. The last time this authority was used outside the normal annual cycle was June of 2020, when CO had just shut down the global economy and nobody knew if banks could survive. Before that, it was never used. The Fed created this emergency power in 2010 and it sat dormant for a decade until the pandemic forced them to activate it. Now they have activated it. Again, that alone should tell you something serious is happening. Here's what a stress test actually does. Because most people hear the term and do not understand what is being tested or why it matters. A bank stress test is not like a medical stress test where they put you on a treadmill and see if your heart can handle exertion. It is a mathematical simulation. Regulators give banks a hypothetical economic scenario. Severe recession, 10% unemployment. Stock market crashes 40%. Commercial real estate prices drop 50%. Interest rates spike or plummet. Then the banks have to calculate what would happen to their balance sheets under those conditions. How many loans would default? How much would their securities portfolio lose in value? How much capital would they have left after absorbing all those losses? The requirement is that even in this severely adverse scenario, banks must maintain minimum capital ratios. For most large banks, that means a common equity Tier 1 ratio above 4 and 5%. If a bank falls below that threshold in the stress scenario, it fails the test. And failing the test has consequences. The bank cannot increase dividends, cannot do stock buybacks, cannot make acquisitions. In extreme cases, regulators can require the bank to raise additional capital or restrict its operations. The scenarios the Fed uses for regular annual stress tests are designed to be worse than the financial crisis, worse than 2008. They want to make sure that if we experience another generational economic catastrophe, the banking system survives without taxpayer bailouts. The 2024 stress test scenario assumed unemployment hitting 10%, GDP declining 4%, commercial real estate prices dropping 40%, and stock markets losing almost half their value. Every single one of the 31 banks tested passed. They all maintained capital above minimum requirements even in that nightmare scenario. The Fed published a statement saying the banking system was resilient and well capitalized. That was 6 months ago. So why 6 months after declaring banks resilient and well capitalized, would regulators suddenly demand emergency testing over a weekend? Let me show you what changed in 6 months, because this is where it gets interesting. The regular stress test results were published in June of 2024. Those tests used data from the end of 2023. A lot has happened since then. Starting in October of 2024, commercial real estate delinquencies started climbing faster than expected. Office buildings in major cities that were valued at hundreds of millions of dollars began selling for 40 and 50 cents on the dollar. New York Community Bank, a $70 billion institution, shocked markets in January of 2024 when it reported a $900 million loss driven entirely by commercial real estate write-downs. The bank's stock collapsed 60% in 2 days. Moody's downgraded their credit rating to junk. Depositors started moving money out. The bank had to arrange an emergency $1 billion capital injection from private investors just to stabilize. That was one bank, one relatively small regional player, but it exposed a problem that exists across the entire banking system. American banks collectively hold $2.9 trillion in commercial real estate loans. That is trillion with a T. Office buildings, shopping malls, apartment complexes, hotels, warehouses. When the pandemic hit in 2020, work patterns changed permanently. Remote work became normalized. Companies realized they did not need as much office space. Leases expired and were not renewed. Office vacancy rates in major cities started climbing. San Francisco hit 34% vacancy. New York crossed 22%. Even smaller cities saw vacancies rise into the mid-teens. When a building goes from 90% occupied to 60% occupied, rental income drops by a third. The property is now worth substantially less than it was when the loan was originated. If the loan was for 80% of the original value and the property is now worth 30% less, the loan is underwater. The borrower owes more than the building is worth. If the borrower cannot make the payments, they default. The bank forecloses. The bank tries to sell the property. Nobody wants to buy an empty office building. The bank ends up selling at a massive loss. That loss comes directly out of the bank's capital. This problem has been building slowly since 2020, but it has been accelerating dramatically in the past 6 months. According to the Mortgage Bankers Association, the delinquency rate on commercial real estate loans held by banks reached 6.8% in the fourth quarter of 2024. That is the highest level since the financial crisis, and it is still climbing. More importantly, there's a maturity wall coming. Between now and the end of 2027, $1.2 trillion in commercial real estate loans will mature. When a loan matures, the borrower has to either pay it off, which almost nobody can do, or refinance it. Refinancing requires the property to appraise at a value that supports the new loan amount. In today's market, properties are appraising 20 to 40% below their 2021 valuations. The borrower faces what is called an equity gap. They owe more than the property is worth. They cannot refinance, they default. The bank takes the loss. Regulators can see this maturity wall approaching. They can see delinquency rates climbing. They can see property values falling, and they are starting to ask a question that has serious implications. If commercial real estate losses continue accelerating, how many banks have enough capital to absorb those losses and remain solvent? The annual stress test from June used assumptions about commercial real estate that are already outdated. The scenario assumed a 40% peak-to-trough decline in commercial real estate prices. We are already seeing declines of 50 to 60% in some markets. The scenario assumed delinquencies would rise gradually. We are seeing them spike. The real world is turning out worse than the severely adverse scenario. That is why the Fed ordered emergency testing. They need updated numbers based on current conditions, not 6-month-old assumptions. But commercial real estate is not the only problem that has gotten worse since June. There's also the issue of unrealized losses on securities portfolios. Let me explain what this means and why it matters. When banks take deposits, they do not just leave that money sitting in a vault. They invest it. A large portion gets invested in U.S. Treasury bonds and mortgage-backed securities because those are considered safe liquid assets. During the pandemic, when interest rates were near zero, banks bought enormous quantities of these securities. Treasuries paying 1%, mortgage-backed securities paying 2%. Then, starting in March of 2022, the Federal Reserve began raising interest rates at the fastest pace in 40 years. They went from 0 to 5.33% in 18 months. When interest rates rise, the value of existing bonds falls. If you own a bond paying 1% and new bonds are paying 5%, your bond is worth a lot less. Nobody wants to pay full price for a bond yielding 1% when they can get 5% elsewhere. Banks hold these securities in 2 categories. Available for sale securities are marked to market, meaning their value on the balance sheet adjusts to reflect current prices. Held-to-maturity securities are carried at original cost, not market value. The theory is that if you hold a bond to maturity, you get your principal back regardless of what happened to the market price in between. So the unrealized loss does not matter. Except it does matter if the bank needs to sell those securities to raise cash. And banks might need to sell if depositors start withdrawing money faster than expected. This is exactly what killed Silicon Valley Bank. They had $15 billion in held-to-maturity securities that were worth 20% less than the bank's balance sheet showed. When depositors started withdrawing, the bank had to sell those securities to raise cash. They realized a $1.8 billion loss. That loss wiped out their capital buffer. Depositors panicked. The bank collapsed in 2 days. According to the FDIC's most recent quarterly banking profile, U.S. banks currently have approximately $500 billion in unrealized losses on securities portfolios. $500 billion. Those losses are sitting on balance sheets hidden by held-to-maturity accounting. As long as banks do not have to sell those securities, the losses stay unrealized. But if deposit outflows accelerate, if banks need liquidity fast, they will have to sell at market prices. The losses become realized. Capital gets wiped out. This is another variable that has changed since the June stress test. Interest rates have remained higher for longer than expected. Securities portfolio losses have not healed. They are still sitting there, a loaded gun pointed at bank capital. Now combine these two problems. Commercial real estate losses accelerating, unrealized securities losses still massive. Add a third factor that has been developing quietly: deposit migration. Since Silicon Valley Bank collapsed in March 2023, depositors have been nervous, especially depositors with balances above the FDIC insurance limit of $250,000. If you are a business owner with $2 million in operating capital or a wealthy individual with $5 million in cash, where do you keep it? Before March 2023, a lot of people kept large deposits at regional banks, higher interest rates than the big banks, more personalized service, a sense that their money was supporting local communities. After Silicon Valley Bank, that calculus changed. If a bank can fail in 48 hours, if your deposits above $250,000 are at risk, why take chances? Move your money to JP Morgan Chase or Bank of America. They are too big to fail. The government will never let them collapse. This thinking is rational from each individual depositor's perspective. But when millions of depositors make the same rational choice simultaneously, it creates a crisis for regional banks. Data from the Federal Reserve shows that since March of 2023, deposits at banks with less than $100 billion in assets have declined by approximately $800 billion. Not all of that moved to big banks. Some went into money market funds. Some went into treasury bills purchased directly from the government. But a substantial portion moved from regional banks to the Big Four. JP Morgan, Bank of America, Wells Fargo, and Citi have gained over $500 billion in deposits in the same period. This is a slow-motion bank run, not panicked people lining up on sidewalks. Quiet, digital, rational decisions made on smartphones and laptops, but the effect is the same. Regional banks lose deposits. They have to sell assets to meet withdrawal demands. They realize losses. Their capital erodes. Some fail. Others merge with stronger institutions. The banking system consolidates. Competition decreases. The too big to fail banks get bigger. Treasury Secretary Elizabeth Hayes testified before Congress in January and was asked directly whether the government would guarantee deposits above FDIC limits if another regional bank failed. Her answer was unambiguous: no. She said the 2023 decision to protect all Silicon Valley Bank depositors was a one-time systemic risk exception and would not be repeated. Depositors are on their own above $250,000. That testimony accelerated deposit migration. If the government is telling you explicitly that they will not protect your uninsured deposits, you move your money. Corporate treasurers heard that testimony and started diversifying. Wealth management advisors heard it and repositioned client accounts. The deposit flow out of regional banks increased. So now you understand the three forces putting pressure on the banking system. Commercial real estate losses escalating beyond stress test assumptions. Unrealized securities losses still massive. Deposit flight from regional to megabanks accelerating. Each problem makes the others worse. Commercial real estate losses cause depositor concern, which causes deposit outflows, which forces asset sales, which realizes securities losses, which depletes capital, which causes more depositor concern. It is a feedback loop, and the Fed is watching it develop in real time. That is why they ordered emergency stress testing Saturday night. They need to know which banks can survive this confluence of pressures and which cannot. The emergency test reportedly focuses on 3 specific scenarios. Scenario 1. Commercial real estate prices decline an additional 30% from current levels, and delinquency rates hit 12%. This would represent total peak-to-trough losses of 60 to 70% in office real estate, consistent with what we are already seeing in the worst affected markets. Scenario 2. 10% of uninsured deposits flee regional banks over a 3-month period, forcing massive security sales and realized losses. Scenario 3. A combination of both. Commercial real estate collapses and depositors panic simultaneously. The question the Fed wants answered is how many of the 32 banks being tested would fall below minimum capital requirements in these scenarios. If the answer is more than a handful, regulators face a crisis. They cannot allow multiple large banks to fail simultaneously. The FDIC does not have the resources. The Deposit Insurance Fund has $128 billion in reserves. If 3 or 4 large regional banks fail, each with $100 billion in deposits, the math stops working. This is where Monday morning becomes critical. The stress test results are due to the Fed by noon Sunday. Regulators will spend Sunday afternoon analyzing the data and making decisions. If the results show widespread vulnerability, they have limited options. Option 1. Arrange emergency mergers over the weekend. Convince strong banks to acquire weak ones before markets open Monday. This happened with First Republic in 2023. J.P. Morgan bought them over a weekend to prevent a chaotic failure. Option 2. Activate emergency lending facilities and flood weak banks with liquidity to prevent deposit runs. The Fed's Bank Term Funding Program was created for exactly this purpose, though it is scheduled to expire in March. Option 3. If the situation is worse than options 1 and 2 can fix, consider more dramatic measures, capital injections, deposit guarantees, or in the absolute worst case, a temporary suspension of withdrawals while the system stabilizes. That last option is called a bank holiday, and it has only been used once in American history in March of 1933. Now, I want to be very clear about something. I'm not predicting a bank holiday. I'm not saying the banking system is about to collapse. What I am saying is that the emergency stress test indicates regulators are concerned enough about current conditions to invoke authorities they rarely use. They are running worst-case scenarios to understand their exposure, and they are doing it over a weekend so they have time to prepare responses before markets open. This is precautionary and prudent, but it is also a signal that the situation is more serious than public statements suggest. If everything was fine, if the June stress test results were still valid, there would be no need for emergency weekend testing. Here is what you need to know as a depositor. First, check how much money you have at each bank where you hold accounts. If you have more than $250,000 at any single institution, that amount above the limit is not insured. If your bank fails, you become an unsecured creditor and might recover 50 to 70 cents on the dollar years from now. If this applies to you, you should diversify immediately. Open accounts at multiple banks. No single institution should hold more than $250,000 of your money. Yes, it is inconvenient. Yes, it means managing multiple accounts, but inconvenience is better than losing hundreds of thousands of dollars. Second, understand whether your bank is among the 32 being tested. The Fed has not publicly announced which banks received the emergency directive, but we can make educated guesses based on the regular stress test cohort. The 8 global systemically important banks are definitely included: J.P. Morgan Chase, Bank of America, Krupp, Wells Fargo, Goldman Sachs, Morgan Stanley, Bank of New York Mellon, and State Street. Those are the biggest and most interconnected. Beyond those 8, the test likely includes large regional banks, U.S. Bancorp, PNC Financial, Truist, Capital One, TD Bank, U.S. Operations, Fifth Third, KeyCorp, Citizens Financial, Regions, M&T Bank, Huntington, Discover, American Express. If you bank at any of these institutions with amounts above FDIC limits, pay close attention to news over the next 48 hours. Third, watch for signals Monday morning. If you see unusual trading volume in bank stocks before the market opens, that indicates information is leaking from the stress test results. If regional bank stocks gap down at the open, that is a bad sign. It means institutional investors who got early access to data are selling. If credit default swap spreads on bank debt widen significantly, that means sophisticated traders are pricing in higher default risk. If the Fed issues any kind of statement Monday morning before markets open, especially anything about liquidity facilities or supervised reactions that confirms the stress test revealed problems. Fourth, review your automatic payments and payroll if you are a business owner. If you have critical bills set to autopay from an account at a potentially vulnerable bank, you need a backup plan. What happens if that account becomes inaccessible? Can you make payroll from a different account? Can you pay your mortgage or rent from savings elsewhere? These are questions you should answer this weekend, not in the middle of a crisis. Fifth, do not panic. This is not a suggestion to withdraw all your money and stuff it under your mattress. If your deposits are under FDIC limits, you're protected. Even if your bank fails, you will get your money back, usually within a few business days. The purpose of understanding what is happening is to make rational preparations, not to create self-fulfilling panic. Banks are fragile because they operate on fractional reserves and depend on deposit or confidence. If everyone tries to withdraw simultaneously, even healthy banks can fail. So, individual protective action is smart. Collective panic is destructive. Let me give you some historical perspective to calibrate your concern. The annual stress tests that started in 2010 were designed to prevent another 2008. In that crisis, we learned that banks were holding enormous amounts of risky mortgage-backed securities that were supposedly safe, but turned out to be worthless. When housing prices fell and mortgages defaulted, those securities collapsed in value. Banks had massive losses and insufficient capital to absorb them. Lehman Brothers failed. Bear Stearns failed. Merrill Lynch had to be rescued. AIG nearly brought down the entire financial system. The government had to do $700 billion in TARP bailouts, plus trillions more in Federal Reserve lending to stabilize things. The stress tests implemented after that crisis are supposed to ensure banks can survive a similar shock without bailouts. For the most part, they have worked. Banks today hold much more capital relative to their assets than they did in 2008. Their portfolios are more diversified. Their risk management is more sophisticated, but stress tests have limitations. They are backward-looking. They use historical data and relationships to model future scenarios. They assume correlations that existed in the past will hold in the future. Sometimes they do not. Commercial real estate losses in office buildings driven by permanent remote work changes were not in historical data. A stress test could not have anticipated that specific risk because it had never happened before. Similarly, the speed of digital bank runs was not fully appreciated until Silicon Valley Bank collapsed in 48 hours. Previous bank failures took weeks or months. The ability of depositors to move billions with smartphone apps created a new kind of vulnerability that stress tests did not capture. So, while the tests are valuable tools, they are not perfect. They can miss emerging risks. This is why emergency mid-cycle testing matters. It allows regulators to update their assumptions based on current conditions rather than waiting for next year's annual test. If commercial real estate is deteriorating faster than the June stress test assumed, the Fed needs to know now. If deposit behaviors have changed in ways that create new vulnerabilities, they need to measure that. Now, the emergency test is an acknowledgement that the world has changed significantly in 6 months, and the banking system's resilience needs to be reassessed. Now let me address the question you're probably asking. If the emergency stress test reveals that multiple banks are vulnerable, what actually happens? The Fed does not publicly announce that Bank X failed the stress test and is in danger of collapsing. That would guarantee a bank run and turn a solvency problem into an immediate liquidity crisis. Instead, they work quietly behind the scenes. They contact bank management. They require detailed plans for raising capital or reducing risk. They restrict dividends and buybacks to preserve capital. They facilitate mergers if necessary. They provide emergency lending if needed. The goal is to address problems before they become visible to the public. But sometimes problems are too big to hide. New York Community Bank's troubles became public because they had to report the losses in quarterly earnings. Once that information was out, depositors reacted. The stock fell, credit ratings dropped, the bank had to disclose capital raising efforts. These are market forces that regulators cannot completely control. If the emergency stress test shows that 10 or 15 banks are critically undercapitalized, the Fed can work with 1 or 2 or 3 quietly. but 10 or 15 exceeds their capacity for quiet resolution. Information leaks, markets react, depositors move money. The crisis becomes self-reinforcing. This is the nightmare scenario that keeps regulators up at night. Not that a bank or two might fail. The system can handle that. The nightmare is contagion. One failure triggering deposit runs at similar institutions. Those runs forcing asset sales causing more losses causing more failures. The dominoes falling faster than regulators can stabilize them. This happened in the Great Depression. It almost happened in 2008. It started happening in March 2023 with Silicon Valley Bank, Signature, and First Republic. The government stopped it with aggressive guarantees and lending, but as Treasury Secretary Hayes made clear, they will not do that again. Which means if contagion starts, it might run further before it gets contained. That brings me to what you should watch for over the next week. Monday, watch bank stocks and credit markets. If regional bank stocks fall 5 to 10% while the overall market is flat, that is information flowing from stress test results. Tuesday and Wednesday, watch for any Fed announcements about supervisory actions or changes to lending facilities. If they extend the bank term funding program beyond its March expiration, that signals they see ongoing stress. Thursday and Friday, watch deposit flow data if you have access to it through financial databases. If the rate of deposit migration from regional to ME banks accelerates, that confirms depositors are reacting to something beyond this week. Watch commercial real estate delinquency data. It gets reported monthly by various industry groups. If delinquencies continue climbing through March and April, pressure on banks intensifies. Watch for bank earnings reports in mid-April. That is when first quarter 2025 results come out. Banks will have to report their loan loss provisions and any write-downs on commercial real estate. If multiple banks report large unexpected losses, markets will react. Watch for any changes to FDIC insurance rules or congressional discussions about expanding coverage. If politicians start talking about raising the $250,000 limit or creating special protections for business accounts, it means they are seeing the same risks regulators are seeing. I want to end by putting this in perspective. The American banking system is the most sophisticated and well-capitalized in the world. The regulatory framework built after 2008 is robust. The banks being stress-tested have strong management teams and deep resources. The most likely outcome of this emergency testing is that regulators identify a few areas of concern require some banks to strengthen capital positions, and the system continues functioning normally. That is the most likely outcome. But most likely is not the same as certain. And the fact that the Fed felt it necessary to invoke emergency testing authorities suggests they are seeing risks serious enough to warrant immediate assessment. Your job as a depositor is not to panic. Your job is to be informed and prepared. Know where your money is. Know whether it is protected. Know what you would do if your bank suddenly restricted access. These are basic financial hygiene practices that everyone should follow, regardless of whether there is an immediate crisis. The emergency stress test is a reminder that banks are not risk-free institutions. There are intermediaries that take deposits and make loans. That business model is inherently fragile because deposits can leave faster than loans can be called in. Deposit insurance and regulatory oversight mitigate that fragility, but do not eliminate it entirely. Check your accounts this weekend. Verify your FDIC coverage. If you're over limits, diversify. If you are a business owner, review your cash management policies. Make sure you have backup access to funds if your primary bank has problems. These are simple, prudent steps that cost you nothing and protect you against tail risks. Monday morning, markets open at 9:30 Eastern. By 9:45, we will start seeing how institutional investors are interpreting whatever information has leaked from the stress test. By noon, patterns will be clear. If bank stocks are getting hammered, if credit spreads are widening, if financial media is reporting rumors of supervisory actions, we will know the test results were concerning. If markets open normally and bank stocks trade in line with broader indexes, we will know the results were reassuring or at least not alarming. Either way, this weekend's emergency stress testing of 32 major banks representing $14 trillion in assets is the most significant regulatory action in the banking sector since March of 2023. It tells us that behind closed doors, in conference rooms at the Federal Reserve, serious people are running serious scenarios and preparing for potential serious problems. That does not mean those problems will materialize. It means regulators are taking the current environment seriously enough to stress test it over a weekend, rather than waiting for the next annual cycle. You should take it seriously too, not with panic, with preparation. Know your exposure, know your protections, know your backup plans, and watch carefully what happens when New York opens Monday morning. Because by 9:31, we are going to know a lot more about the health of the American banking system than we know right now. Welcome to Geopolitics of Money.